Hello and welcome to the look ahead for the week beginning the 30th of June with me, Candice Ngoza, Senior Market Analyst at City Index. So let's crack on. I'm just going to ask you to have a quick read of the risk warning. Excellent. So let's crack straight on. So this is the S&P 500 trading at record highs. Yes, that's right. So we've seen US stocks gain around 3% across the week. We're still just haven't started the final trading day of the week yet in the US, so there could potentially be more gains to come. You've got the S&P 500 at a record high. You've got the NASDAQ at a record high. And then you've also got the US dollar, which is trading down around 1.5% this week. So very much an unwinding of that risk off that we saw surrounding the Israel-Iran conflict, as we saw that ceasefire come into place at the start of the week and is still holding up, crucially, which is keeping the market mood very buoyant. In addition to the end of that conflict, we've also got rising expectations surrounding Federal Reserve Fed rate cuts. And that's basically, I mean, we've had Trump criticize Federal Reserve Chair Jerome Powell, who testified twice before Congress this week, and will continue to warn over the possibilities of higher inflation owing to Trump's trade tariffs, although we have seen that other Fed members are starting to say that they could be open to a July rate cut. Also, let's not forget that Powell also said that if the hotter inflation doesn't show through, then the Fed could continue cutting rates. Now, this obviously isn't as fast as what Trump would like. Trump has his hands tied to a degree because he can't replace Federal Reserve Chair Jerome Powell until his term is over. However, there were reports in the Wall Street Journal this week that Trump is considering nominating and announcing his replacement Federal Reserve Chair Jerome Powell early in September, October time, which is well ahead of the end of the term for Powell, which is in May. Now, what that means is that the market will adjust its expectations, because obviously it works on future expectations for interest rates, according to the nomination, and the nomination is almost certainly going to be more aligned with Trump's desire for lower interest rates. So we've seen, as a result, the markets having its expectations surrounding rate cuts swayed. We're also, as I said, mentioned, seeing a little bit of a slightly softer, more dovish stance from Powell than we did the previous week. Definitely not dovish, but more dovish than what he was, or should I say less hawkish. And as a result, that has sent US stocks soaring. We've also seen the return of that AI focus and AI trade after a very disruptive first 6 months of the year. So things are looking up as far as the stock markets are concerned. Now, that's what's been happening so far. So let's just have a look at this S&P 500 chart. We've pushed above this key level here, the 61.25, trading at fresh record highs. Blue skies above. Next logical level to be looking out for is 6,200 and 6,300. They're just going to pull up the US dollar chart just to have a look here at what is going on. We can see how steeply that has fallen across 2025. We just pan out to the weekly move. So we've seen this sharp drop. We're trading at the lowest levels since 2022. Next levels we're looking out for on the downside is 95, and that's if we break below this current level here, about the low of this week, which was around the 97 level. So that's what's happening with the US dollar. There are obviously some currencies that are benefiting more from that US dollar than others. US dollar, sterling is one of them, pushing up to levels that we saw 3.5 years ago. So, I mean, I pulled up the sterling as well because on Monday we've got GDP data from the UK, which is expected to confirm the preliminary 0.7% growth quarter on quarter and 1.3% growth on an annual basis. This data now is considered rather stale, given that we are now at the end of Q2. So it's not really likely to be that market moving unless there is a strong upward or downward revision. But either way, our expectations are for growth in the UK to really slow down considerably. Their strong first quarter is more a result of pull forward ahead of the Trump trade tariffs rather than the picture of a strong fundamental basis. So we're expecting growth to slow over the remainder of the year. The Bank of England has said that they expect that as well. And I mean, if we just think about what we're seeing growth-wise, wage-wise, and in the labour market as well, we've seen that industry data this week has showed us that wage growth has slowed back to inflation in the private sector. Job vacancies are also significantly lower, pointing to some weakness there. Now, obviously, if we get some weakness in the jobs market, then we start to see consumer confidence come under pressure, reduce spending, and that slows the economy. But for now, sterling US dollar is doing well, and that is basically a good example of the dollar weakness story showing through. That said, the Bank of England is expected to cut rates in August. That's when we're expecting the next rate cut from the Bank of England. Plenty of data to come in between now and then. Particularly wage growth will be watched closely, as well as service sector inflation. But as far as this chart is concerned, interesting because we are actually seeing a bit of RSI divergence there. Well, no, it's pushed through actually, so maybe not so bad. So, I mean, this powered up to this level here, which is 137.50, highest level since 2022, trading within this rising channel. It's above the 50 SMA, above the 20 SMA. Next level to be looking for on the upside is 138, which is also just above the midpoint of the channel. And then to be pushing higher, I mean, that brings 140 into play on the upside. As far as support is concerned, support can be seen here at the 136.25 level. That's the high that we saw. The high that we saw in early June. It would take a break below this level here, which is the 134.50, to really create a lower low and see a break out of that rising channel. Also, data-wise, we've got Eurozone inflation. So let's just have a look at what's going on with the Euro-US dollar. Euro-US dollar has been another one that has benefited immensely from this US dollar weakness that we've seen. We've pushed up to, again, levels that have not been seen for around 4 years, just testing the top band of that rising channel as we speak. But worth just panning out here, just though to get a sense of the bigger picture, because actually compared to 2021 when it was up at 122, you know, we're actually, this potentially could just be early days of a breakout, despite the fact that we've had a pretty strong move up so far. So I mean, as far as levels to be watching on the upside, 120 would be a next level to be watching. 119 as well was a level that was fairly important back in the day, but we are just tipping into overbought territory. So the fact that we're testing that upper band of that rising channel and that we're tipping into overbought territory does suggest that maybe there could be a period of consolidation or just an easing lower of the price. But that said, the uptrend is still very much intact. As far as support is concerned, 115.75, that was the high that we saw back in April, and below that 115 is the level to be watching out for. It'd take a move below the 114.50 to create a lower low. As far as inflation is concerned, sorry, just whilst we're looking, we've been looking at the chart there. Inflation in the Eurozone fell to 1.9% in May. That was down from 2.2% in April, and also the first time in 7 months that it was below the ECB's target of 2%. Now, price pressures could continue to ease further in the coming months, given this strength that we're seeing in the euro, which trades at a 4-year high versus the US dollar. As far as rate cuts are concerned, I mean, if we do see cooling inflation, that could fuel expectations of rate cuts from the ECB. But the ECB have cut interest rates for 8 straight meetings, taking the deposit rate to 2% in a bid to try and boost growth. However, I think the ECB is increasingly more divided over what to do next. We have Lagarde hinting in the July meeting that the central bank could actually pause rates until there's more clarity over Trump's trade tariffs. However, we've also got other ECB doves who have suggested that the central bank can keep cutting rates despite all the oil market volatility that we've seen. But cooler than expected inflation could drive those expectations further that the ECB will need to cut rates again. And this is interesting. This is the DAX. So now, while we've seen the US stocks rise to record highs, the DAX is just struggling to get over that 20 SMA around the 23,800 level. So we had that fall down from the record high that was 24,490, dropped down to this level here, which was exactly 23,000. We've managed a recovery, but the recovery is just struggling there at the 20 SMA. Need to get a rise above the 24,000 in order to bring 24,500 back. Back into play. As far as support levels are concerned, you've got that 23,385 on the downside. That was the highs that we saw at the end of March, and then a break below the 23,000 level there is going to create a lower low. Now I'm just going to bring up the NASDAQ because we also have Federal Reserve Chair Jerome Powell speaking next week. Now, as I mentioned, Jerome Powell has spoken on several occasions. He testified twice this week. We had the FOMC meeting last week. And his comments are going to be watched very closely following that testimony before Congress last week, and as he's also facing ongoing criticism from Trump. Now, as I mentioned at the beginning, Powell has adopted a slightly more cautious approach to cutting interest rates further amid expectations that he sees inflation creeping higher owing to Trump's trade tariffs. However, data so far has not been showing this necessarily. We've not seen any meaningful uptick in inflation. This is being recorded ahead of the US core PCE data today. However, I mean, if we continue to see, he's also said that as long as we don't see that tick up in inflation, then the Fed could continue to cut rates. So it's going to be very interesting, well, firstly to see what core PCE data says today, but also if there's any response as well to Trump's comment this week, or whether Powell will just continue as normal without touching on those rumors regarding Trump's nominees. If we do get a slightly more dovish sounding Powell, as we did, and I think it's going to depend a lot on what we see from this core PCE data today. But if we get cooling core PCE, then that does give Powell a bit more rein to be less concerned over the potential uptick in inflation. And if that is the case, then we could see the NASDAQ continuing to power on to fresh record highs as it is. At the moment, we're trading at the 22,550 level. 23,000 is the next level on the upside to be watching. Support 22,200, that's 245. That's the high that we saw back in February. But it's going to take a move below 21,500 to create a lower low and negate the near-term downtrend. just watching this here, we've got the golden cross occurring with the 50 SMA part rising above the 200 SMA in a bullish signal. Also, just whilst we're here, let's have a quick look at what gold's doing. Just oops, the daisy, as far as whenever we talk about interest rates in the US, it's always interesting to see what gold's going on. And look, we're seeing a breakdown of gold. It seems to be breaking down that trend line that has been in place at least until since early April. So we saw 3 attempts to break above the 3,450 level, failed to do so, has rebounded lower and is testing at the moment the 32.85 level, so just below the 3,300 level, just around that support zone. If we get a break below there, then watch out for this level here, 3,200, next level on the downside. If we do get a more dovish sounding pound, then that could help lift gold. But I think what we're seeing here is the unwinding of that risk premium that was added during the Israel conflict. We do get more dovish expectations surrounding the Fed, then that could give the pull the US dollar lower and boost gold a little bit. Although what is interesting is the fact that we are seeing gold falling and the US dollar falling, so that does suggest that it's more of an unwinding of safe havens. And then finally we've got the US non-farm payroll on Friday. Now, US non-farm payroll expected, well, we saw 139,000 jobs added in the May report. That was below the 150,000 that were expected, and that was combined with a downward revision of 95,000 in the previous 2 months, amid signs of really a slowdown in the labour market. We did see that the unemployment level held steady at 4.2%, with wage growth outstripping inflation. Also, I think it's worth noting that recent jobless claims have been pointing to or showing signs of weakness in the labour market, and investors will be watching closely to see whether this is also going to be showing up in the non-farm payroll report. Obviously, weaker than expected data could pull the US dollar lower, raise concerns over the outlook for the economy, but also I think it was going to raise expectations that the Federal Reserve may be cutting interest rates sooner, because if we see that weakness in the jobs market and if we see that inflation isn't ticking meaningfully higher, then the Fed will need to act on the data that they have in front of them. So this is the US dollar, Japanese yen. Interestingly, the Japanese yen hasn't benefited that much from recent US dollar weakness. We've seen that obviously across the beginning of the year. We saw the Japanese yen gain, but here, despite ongoing weakness in the US dollar, we've seen more of a holding pattern in USD Japanese yen. And that's because the market's starting to slightly just rein in expectations of further rate hikes from the Bank of Japan, at least in the near term. Sort of comments from the Bank of Japan and have been a little bit more wait and see mode, particularly given the concerns over the impact of Trump's trade tariffs on global trade and also the impact that that could then have on the Japanese economy. If we do get some weaker than expected non-farm payrolls, this will be the level down here, 142.50. That's the level that we'll be looking to be tested. A break below that will create a lower low and look towards the 140 level. On the upside, just first of all, 145, get above 145, then that 146 level is going to be an important level before heading all the way up to 148.60. So 148.50. That was the level that we saw the high in May. That could come if we see stronger than expected US jobs reports. So in addition to everything that's going on in the economic calendar, obviously Trump's trade tariffs will also be in focus because we're moving towards that deadline for the July 9th. So we'll be expecting to hear some sort of update as far as what we'll be expecting the countries, different countries to be paying. So which countries have managed to agree a deal, which managed have not, and what that means for as far as reciprocal tariffs are concerned. So that could be the main focus of the week rather than the economic data, depending on when we get any news surrounding that. The data, the deadline is, as I said, the 9th of July. So we've got a little bit over a week to go until that happens. So it depends very much whether we'd get an update or not. With Trump, it's never quite known. So that does mean that we do just need to be wary that headlines could continue to move the market next week if Trump does touch on the trade subject. Excellent. Well, I hope you've enjoyed. Oh, sorry, one more thing. Let's do is also the we've also got Chinese PMI data. Okay, so it's the Chinese cakes in PMI figures. Basically, yeah, you've got the official PMI data, which is set for release on Monday, which is expected to basically remain in contraction, whilst non-manufacturing is expected to remain broadly unchanged on month. And then we've got the cakes in manufacturing, which will be released on Tuesday, and the services PMI on Thursday. So the data is going to be watched very closely for any signs of how the Chinese economy is holding up. It's expected to show that the economy remains near a standstill in June as sort of the updates surrounding trade tariffs come into play. If we do get weaker than expected data, that's going to raise concerns over the health of the Chinese economy as we see these trade tariffs continue. Although they're significantly down from what they were previously, there is still some impact on the Chinese economy. As far as the Hang Seng is concerned, we're actually seeing some, we've seen a solid recovery from that low there in early April, 18,839, currently trading up around 24,180. So we're looking for a rise above the 24,500 to create a higher high. This does seem, we've been creating a series of higher highs and higher lows. So this trend does seem to be on track as long as momentum doesn't fall away. So I hope you've liked everything that you've seen today. If you have, then please do give this video a like, and for more videos like it, then please do subscribe.